All right. We should be live. Hang on, I'm logging in the chat if you're there. Can you hear me? Like it. You have to put it. I'm not going to listen to just a like. Oh, cool. I did it right on the first time. This is so fun. And it's working on the program I like. So, Elaine, thanks for getting on here. Sorry, Miramo. Sorry to out you like that. You have a good flight? Good. Glad to hear it. So you're gonna be the first one to hear this then, and I'll probably say it 3 or 4 times while I'm on here. But I discovered, or I didn't discover, that can't be true. That cannot be true. Oh my god, it is true. 67 and only raining a little bit. That's pretty cool. Well, anyway, all right. I'm cold. It's like 53 here. I I got a jacket on inside. That's how cold it is here. All right, we're gonna start talking mortgage stuff. Hopefully, other people are gonna join, and I can repeat myself. Let me do this too. I am not gonna be in the chat. I'm gonna have something else going. All right, so we're gonna talk about how to pay off your mortgage. I came up with this, or thought of this, or discovered it, however you want to call it, a new way to go about it. So one thing that people would typically do is say, let me know if you can read this or if it's too small or what. So say your mortgage payment is $3,000. Cool. And so what people will do is instead of just paying $3,000 to the mortgage company, they'll pay $3,100. And so with that, your payment will go down over time, and sorry, your payment will go down. Your balance will go down faster because every penny that you put in above this 3,000 goes directly towards the principal of your loan. So every extra payment is a good thing to do, but this is terribly inefficient because this doesn't always change your payment amount, and it's not. They don't always re-amortize your loan. So the amortization. This is my favorite graph to draw. I think I'm gonna get this. I'll do it down here, tattooed on my body at some point because I think it's cool. So when you start, this is interest, and this one is principal. So when you start, your first mortgage payment is a ton of interest, a little bit of principal. The last one is a lot of principal, a little bit of interest, and then these lines connect like this. And so it goes the opposite way, like this as well. So it starts, yeah, it looks like that. So it doesn't always re-amortize. So every time you make an extra payment, it's not like you jump forward in this graph, depending on amortization. Go Google that word. And so that's basically this process. And so how your loan is paid off over time. So your first payment, it starts off with being just a little bit of principal and a lot of bit of interest because that's how investors set everything up. And then as you make your last payment, so if you actually had a loan for 30 years and your 360th payment would be a lot of a lot of principal, a little bit of interest. It's like it starts off pretty astronomical. It's like 97 to 3%. Like it's you do not pay your loan off hardly at all at the beginning. And so there's people that say, okay, well, if I pay more, doesn't that kind of bring this gap over? And so if you do a 15-year loan, So this is a 30-year loan. If you do a 50, that's not the same size. If you do a 15-year loan, it's going to look more like this. It's basically this graph, but like cut off in half. So it's kind of the same thing, but you do this further out. So your first payment is about 50-50. So when you get to year 15, your payment is about 50% interest, 50% principal. So what people will do is that's why they like these 15 years, because you pay off your loan faster. But that doesn't always work out, and servicers kind of have funky rules where they don't always re-amortize your loan as you're paying it off each month. They'll make you, do something else to make you pay it off sooner. So to kind of get around those rules, here's what I've come up with. So instead of making your payment, you got $3,000. What color do we want? I like blue. The blue looked, but I got the title in blue. That's fine. All right. So we got the $3,000 mortgage payment. And so we got that in our checking. And typically what people move, checking. And so what typically a lot of people do is they'll take this and they'll just send it directly to the mortgage company. And so we'll put this up. Let's do it all different colors. I like color today. And so they'll just send their money directly this way. And so when you do that, you don't pay off your loan any faster. You don't do anything else to make your loan or pay off your loan at all. So what people will do is they'll pay $3,100. So this is option one. And then you send that directly to the mortgage company. So what I'm suggesting is we add a little step in the middle. We add a savings account. There's a couple of things that could be in this savings account factor, but savings accounts are the easiest ones to get to. You could also do a money market account. Those are very similar, tend to have a little bit higher interest rates, maybe not as much flexibility. I found out that my savings account with American Express doesn't have a limit on how many transactions I can do with it. That's usually one of the big things with savings accounts, is that you can't make 50 transactions in a month, because that's not what a savings account's for. But a lot of them, including the one that I have with American Express, does not have a maximum amount of transactions you can do. So we're going to add this step in the middle. We got $3,100 that we're going to be paying towards our mortgage, and we're going to send that to our savings account. And so now, every day that we have $1 in this account, it goes up by whatever your APY is. So annual percentage yield. A lot of them are around 4% right now, but it will change month to month. I think mine is like 3.8. I think there were some out there that were like 4.1, 4.2. And so while it's sitting there, you actually have 15 days. We're going to let it sit in there for 15 days. Because while most people think your mortgage payment is due on the 1st, it's actually not due until the 15th before you get a penalty. So you can make your payment on the 14th every month, and you've got an extra 14 days where you can have interest being earned on the savings account 4%. And so while we're earning that interest for half the month in there, then we send $3,000 to the mortgage company. And so then this is going to start compounding over time. This is the 8th wonder of the world that Einstein said, compound interest. And so this is what we want to do. We want to start taking advantage of this. And the other thing is that it provides is liquidity. Liquidity. So liquidity means that your cash is available to you. You can have it. You can spend it. You can do what you want with it. You can get it. Say, shoot, I need to buy a new car. You can't just take it out of your house because you've got equity. It's not liquid. So when it's in a savings account, it's liquid. You can go get it. You can use it if you want to. So liquidity is very key. I think it's a very powerful thing because, like I said, if you have got a lot of money but you can't get access to it, do you really have a lot of money? Like a lot of people who own a lot of stock, like Elon, say he's really, really rich, but he owns so much stock in his companies that he can't sell, he can't get access to. So all those billions of dollars that he has, most of it's tied up in stock. So he's not like he's got a checking account for $80 billion. There's loopholes for that because he can do things like take a loan against his stock portfolio, but then he's paying interest, but he's kind of paying it back to himself because it's based on his own asset. But that's besides the point. We want liquidity. When a lot of people, we're going to take a step back, and so when a lot of people say they want to pay off their house, it's because you got to ask why. Why do you want to pay off your house? Somebody put something in the chat for why you would want to pay off your house. The number one answer that I get is that I just don't want to have a payment anymore. And then I say, okay, well, why don't you want a payment anymore? Because I want to do it with whatever I want with my money. And so really what you're looking for is financial freedom. You're not looking to pay off your mortgage. Lower payments per month, that's a good one. So, but we're going to, again, one more step past that. Why do you want low payments per month? So that you can have freedom with your money, right? And so that's really what we're looking for. It's not so just that, hey, I don't want to have payments that I owe each month. Is that I want to have freedom with my money so I can do whatever I want with my money. But the more money that we send into this account, the less access we get to it. Doing a cash out refinance is not easy, and like if you do desperately need a cash out refinance, say you lost a job, you probably don't qualify for a cash out refinance. So we don't want to put money in here hoping someday that I can get access to it. We want to have a mortgage payment that's reasonable, that we don't feel guilty about paying every month, and then still have savings that if we ever needed to, we could get access to it. So again, we don't want to pay off our mortgage just because it means freedom. It doesn't mean freedom. It means you have a bunch of money sitting in your house that you can't get access to. So what we're going to do with this is we're going to keep doing this strategy. So we're going to take $1,000 or $3,100 from checking, put it in the savings. We're going to earn interest over 15 days. So let's do that math real quick. At 4%, it's going to be a small number. So if we do $3,100, we got to do this first. So say it's 4%, 0.04, and you got to divide it by 12 because it's every 12 months. And you times that by $3,100. So we made $10. Seems pretty insignificant, right? So after we make this payment, we're going to have $110 in that account. So we made $10. It's really going to be, since it's only in there for half the month, it's probably going to turn out to be like 105. But we still made $5 by doing nothing. Okay, the math is this is your APY. How much you're earning in your savings account. This is the annual amount that you would earn. So if you put $100 in it at the beginning of the year, at the end of the year, you should have $4. And so if we did this and then we divide it by 12, we get like 0.003%. And that's how much you earn per month. So if you do $3,100 times 0.003%, you get 110, but we're only leaving in there for about half the month because we're leaving in there for 15 days before we incur a late fee on our mortgage, sending the $3,000 over. We're going to end up with $105 in there, and then the next month we're going to do the same thing, $3,100 into this account, and now we're going to have $3,205 for 15 days. So let's do that. 3,205 times 0.0003. Oh, I did too many. 4.04 divided by 12 times 3,205. So we made another 10.6, but we divide that by 2, so we made $5.50. So we'll just call it another 5, because it's going to take some time to compound. And so after we make our payment to the mortgage company of $3,000, then we're going to end up with $210 in this account. So this is going to go up over time, and the balance in your mortgage is going to go down at the regular amortization schedule. And so the point is that once you get this number high enough to pay off your mortgage, you've essentially paid off your mortgage, but you already have access to most of the money. So you can use the money, and then at that point you have the financial freedom, the mental freedom to do whatever you want with it. But you can go on and live your life and take advantage of the bonuses that come with having a mortgage, like it being tax deductible. All right, so I think we got some new people joining. I want to circle back on what we got going on. On what we're talking about. So we're talking about amortization and paying off your mortgage. So a lot of people do is they'll just take $3,000 or $3,100 and just pay off their mortgage, but that doesn't pay it off very quickly. If you only do it $100, it'll pay it off like 3 years early, something like that. So what we want to do is we're going to take $3,100, put it into a savings account. It's going to sit there for 15 days, and we're going to have liquidity. That's we have access to it. And over that 15 days, we're going to make $5, so our extra $100 turns to $105. On the 15th day or the 13th or 14th day, we're going to send it to the mortgage company. They get their $3,000, and then this account is going to grow over time. And then eventually, we're going to have enough money in this savings account where we can pay off our mortgage in full if we wanted to, but we don't have to. We'll have access to that money. Another big thing on why this is key is that the number one reason people regret being a homeowner is because they don't have enough money to pay for maintenance. If you ever hear somebody say, I bought a house and it was a mistake, it's because they didn't plan for maintenance. They didn't plan for anything you have to fix. One, you get a home warranty, so you got 2 years of kind of like free repairs. So if your fridge breaks down, your AC breaks down, anything breaks down, then you can get it repaired. But after those 2 years, you need to have some kind of reserves in case your garage door breaks. You need to, you get a leak in your house. You got mold through 2 different floors. That's going to cost you like 10 grand or more, depending on where you live. So you need to have liquidity in order to maintain your house and do everything properly. You need to get solar panels or it's whatever it is. So liquidity is such a huge factor in a lot of this stuff. And so even though this mathematically does not pay it off as fast as this does, you're going to lose 2 years, but you have so much more financial freedom, which again is our ultimate goal with doing a lot of this stuff. So we're not looking to just pay off the mortgage because we want to pay off the mortgage. We're looking to do that because we want financial freedom. And this is going to give us financial freedom a lot sooner than if we're just paying down our balance. All right, cool. Give me 1 second because my dog is scratching at the door. She really wants in. All right, you win. Stay. Thank you. You can have your little coffee. All right, so we're talking about let her in. She is in. Okay, so the goal isn't to pay off your mortgage, but to get more liquid money, which is the goal. Yes, liquid gold. Liquid gold. So again, we don't want to pay off our mortgage. The benefits of there are benefits of having a mortgage. One is that it's tax deductible. There's no other debt that you can get that's tax deductible. So it's going to decrease your taxable liability. You can kind of think of your mortgage interest having like a 20% discount, whatever your rate is, your tax rate. And so we want to be able to do that so we can leverage it and do different things with our taxes to make it better for us. I guess it's playtime. She hears me talking. She thinks people are home. All right. Are there any questions about paying off your mortgage? Probably going to do this 2 or 3 more times, but we'll do something else for now. I'm going to draw my pretty little graph again. Principal, and we got interest. All right. Ooh. So a couple things that I want to talk about today. These are the things you need to qualify for a house. Most people think you need to have all of these completely lined up, be 100% perfect before you buy, but that's not true. You can really have 3 out of the 4, and you're good to go. And I mean that. You do not need to have all these. You can straight up not have one of these and still qualify for a loan. Can I get rid of the glare on the board? Which glare? The one that's my computer screen? No. Where is the glare? We'll put some spots where I think the glare is. 1. And then 2. 4, 3. 2. Yes, that would be my computer. So no, I can't unless you want me to turn off my computer, which means I turn you guys off. So let's see where the issue is. So it's up here. These are notes for me, and then there's another one right on this one that you can't see, right? Yep. Okay. All right. I'll figure this out one day. But maybe I could just turn on dark mode on my computer. Another time, I'll do that. So it's not white bars, it's dark bars. So we're talking about getting pre-qualified. If you wanted to buy a house, you can have 3 of these and not all of them. Know that you're being a pest. You're going to get kicked out again. So if you have income, assets, and a good credit score, and you have terrible monthly debt, we can probably still get you to qualify for a house. If you have no credit score, this is a new one. If you have no credit score, you don't have any credit, you've never opened a credit card, you can still qualify to buy a house. We use things like if you have rental payments or utilities or a phone bill. Leave it, Nova. This was a bad idea. You're getting kicked out. Leave it. Hey, leave it. One second, everybody. Come on, out. Get out of here. Kids. All right, so you cannot have a credit score. You can do things like use your cell phone bill. No credit score, 0. You got no credit. Now, if you have really bad credit, it would be a different story. So you have to have really good compensating factors in these other ones. But no credit score is totally fine. You can qualify for most programs. But even if you do have a really beat up score, you've got excellent income and a lot of assets, you can still qualify for a loan. On the other hand, so if you have no assets, but you have decent income, a decent credit score, and not a whole lot of debt, we can do things like DPA programs, down payment assistance. I get questions about these a lot. Gotta give myself enough room. Here we go. Assistance. So the standard for most loans is that on a conventional loan, that's kind of like the vanilla product, you only need 3% down. So that's a first-time homebuyer product that you can do. It's not quite down payment assistance that goes well beyond that. You can do 3% down on an FHA, which is a government program that was created kind of to help people with a little bit beat up credit score. So if you kind of are lacking in one of these areas, not like completely omitting it, then you can still get this one. This one you can do 3.5%. So a lot of people think that you need 20% down, but you don't need 20% down. You need 3 or 3.5%. A lot of people, if they're a second-time home buyer, they'll do 5% or 10%. But a lot of people just get stuck in their head they need to do 20 because that's what their parents told them. They say that's the safest one. And one of the main reasons is because of mortgage insurance. Insurance. So mortgage insurance is one of the bad things about a mortgage. It's no longer tax deductible. It is a cost that you have to pay that insures the lender that if you ever stopped paying your mortgage, they would get repaid something. They're not going to completely lose out on stuff. So on top of them getting to foreclose your house, they get to cash in on mortgage insurance. So you're paying for something that doesn't benefit you and you don't get to write it off in your taxes. So that is one of the goals for a lot of people who do these low down payment programs is to get into a different loan where they don't have to pay mortgage insurance because the only thing it does is protects the lender. So it's not for you. So that's why people say you need to put down 20%. It's because if you put 20% down on a conventional loan, you don't have to pay mortgage insurance. But a lot of times, if you've got good credit, this is not as painful as you think it is. Like I've had some where it's like they had to get a conventional loan. They didn't have great credit, so it was like $320 a month. But what he's going to do is that after he fixes up his credit a little bit in 6 months, he's going to come back. He's going to refinance. This 320 is going to turn into 110. That's not 110. That's 110. And I've seen this be as low as like $50 a month. So it's really not as terrible as a lot of people think it is. So, I mean, if you could buy a house, and the worst thing about it is that there's a $50 payment on there that you wish you didn't have, you're going to be coming out ahead pretty good. All right, so we talked about this. So down payment assistance program. So this is like the regular stuff. These aren't even down payment assistance programs. They're just the regular lowest down payment amount you can do on a conventional FHA. But these other down payment assistance programs, what they do is they'll offer you either grants or a repayable second. So we're going to do grant, and that equals free money, means you don't have to pay it back, you don't owe anything, or a second. Repayable. So that means you got to repay it. We can just put repay. That's an easier word. And sometimes it might be deferred. I don't know how to spell it. Sorry for the handwriting. So if you get a grant, that means you got free money. They might have some kind of constituent or stipulations where you have to live in the house for a year. You can't pay it off in 6 months, or can't pay it off in a year, or you can pay it off, but you still have to live there for 2 years, something like that. There might be stipulations with grants, but for seconds, there's 2 ways to go about it. One is you have to repay it, so you kind of have to pay it back. Like you get 2 loans on your house. The smaller one is only going to be for that 3% or the 3.5%. You repay it over time. A lot of times these are shorter terms or like 10-year terms, something like that. So they can be that. Or it's a deferred second loan, meaning you don't have any payment on it. But at the time that you refinance, or if you pay off the house, something like that, you will have to pay off the second. So let's do a quick example of this. See if you guys can see. Yeah, you can see. Let's do an easy example. This might only work in like places like Kentucky, but we're going to go for it. So say we bought a $100,000 house. We put, let's do 3% down. So that means you're going to be $97,000 loan amount. We're going to call that your first. And then we're going to get a second of $3,000. Obviously, the payment on the second, even if it's a 10-year term, is going to be a heck of a lot less than on the $97,000. So you don't really need to worry about this payment that much because it's going to be so much smaller. The only thing that's an issue with this that prevents you from doing 0% down is that there's going to be closing costs. I pick them in red because they're the devil. So closing costs are like there's closing companies, escrow and title, that you have to pay money to in order to facilitate the transaction. Escrow's job is to collect all the money in, they disperse it out where it's supposed to go, they pay your real estate agent, they pay off the loan from the seller, they pay your notary, lots of different things. So they're basically the hub for all the world that money goes, and they send it out where it's supposed to be. A title insurance will protect you and the seller to make sure that no liens come on title that weren't supposed to be on there. So you're getting a house that's only your mortgage. You don't have to worry about that. So this is where a lot of people get tripped up, and I've seen people say that they forgot or were never told about closing costs. You got to make sure you account for this. And unfortunately, it's impossible to get an exact estimate on how much closing costs are going to be until you actually get under contract. But the general rule of thumb is like anywhere between 3 and 4% of this amount. So it's going to be about $3,000 to $4,000 on top of that. Another thing that's part of closing costs is your impounds or escrow account. And what that does is it's going to pay your taxes and insurance for you. So you put money into this impound account, and usually put some up front, as well as paying like your insurance you pay yearly if you have an escrow account. So you'll pay that all up front, then you'll put in a little bit of buffer in there so that when it comes due again, there's a little bit extra because your insurance tends to go up every year. Same thing with your taxes, tends to go up a little bit every year. So these are the two things you need to watch out for, is that even if you get a down payment assistance program, it's going to cover 100% of the down payment. You still have to pay closing costs unless you can negotiate it with the seller that they can pay these. So the one thing that's good about closing costs is that it can be paid by anybody. So it doesn't have to be paid by you. It's the only thing, even on a regular transaction, you can negotiate it into your contract and have your closing costs and impounds paid for by somebody else. So yeah, that means your impounds, your taxes and insurance for your first year, you can have somebody else pay those, even though you would think that that's my fee, I have to pay for it. When it's done through escrow, you can have someone else pay for it. So that can be done through lender credit. So that means we could give you what's called premium pricing. So give you a little bit higher interest rate and then you get credit towards your closing costs, or you can have your real estate agent give it to you, so you can negotiate into your contract with them, or you can have the seller do it, or you can have the seller's real estate agent do it. So there's lots of different ways you can get that done. So that's how you get your closing costs paid for. So if you can do those things, you buy a $100,000 house, 3% down, which gives you a $97,000 loan amount, $3,000 second, which can be either a grant or a second, but it's going to be either repayable or deferred, one of those two. And then you negotiate someone in there to pay for your closing costs and your impounds. Then you can actually walk into a house with $0 down. And I've seen people do it. So it is possible to buy a house with no money. The only hurdle I would say with that is that typically the sellers are going to want what's called an earnest money deposit, or an EMD, earnest money deposit. We can see that, yeah. That looks like an O, but it's a D. So earnest money deposit is basically like a good faith at the beginning of the contract that you put into escrow saying, hey, yes, I'm going to buy this house. I do want to buy this house. I plan on moving forward with this. Here's some money to prove that I'm going to do that. But if you put in an EMD and then you actually get all this stuff credited for you, so you get all your closing costs, all your impounds paid for, this EMD will actually get sent back to you at the close of escrow. I've had that happen as well, where they literally put in $1,000 or it was $1,500 to go buy a house, ended up getting a down payment assistance program, so they didn't have down payment. They negotiated their closing costs into the deal, and then they got their EMD refunded to them at the end of the transaction. All right. If anybody has any questions about mortgages or how to get pre-qualified, if you want to get pre-qualified, this is what I would need to know from you. What's your income? How much do you have in assets? What's your credit score? And how much do you have in monthly debts that's on your credit? So a lot of people don't know how much they actually have in monthly debts. I don't care about how much in total you have in monthly debts. So if you have a $6,000 credit card, that doesn't really matter in terms of a mortgage. It matters how much the minimum payment is on that credit card. Because if it's a credit card that's got a $150 monthly payment, that's the number that's important. But if it's only $25, then you're in a much better shape. If you don't know this information and you want to know what it is, I'm a big fan of Credit Karma. It's very easy to use. I have no affiliation with them, but you can go on there and get your credit scores. I think they give you 2 scores for free, and there's also a way to get your what they call your credit report on there, which will tell you your monthly debts, all of your monthly debts. So you can know exactly what you're going to get. And so the reason that this is important is because we have this thing called a debt to income ratio, which is applicable on almost every loan except for veteran loans and these cool things called DSCR loans, which are for investors. So if you're buying a home for yourself and you're not a veteran, you're going to be dealing with something called a debt to income ratio, DTI, and it is a percentage. So what we have to do is calculate how much of a percentage of your debt is your income. So say you make, again, we'll just use easy numbers here, 10 grand a month. If your housing payment, so your mortgage plus all your monthly debt that's on your credit is $5,000, your debt to income ratio is 50%. We getting the math here? Yeah. And so typically the number that we want for a debt to income ratio for most programs, the one to shoot for is about, what do I want that color? We want this color. 45% is kind of like the golden rule. If you ask a financial advisor, they'll say 30, but they tend to be, uber conservative on a lot of stuff. So yeah, sure. 30 is like a good number of like, I wish that would happen to me, but in Southern California, it's definitely not a realistic thing to get that. You see very few 30s in Southern California, even for people buying very small places. So if you take all of your income, we'll do it this way. Income, and we calculate it monthly. And up here is going to be a bunch of different stuff. Your mortgage and all your housing related payments. So it would be like taxes, insurance, mortgage insurance, if you had HOA, and then anything that's on your credit. So it would be like your car, student loans, credit cards, whatever it is. So we're going to take all of those, add it up, and then divide it by your income, and that is going to equal your DTI. All right, any questions on DTI or debt to income ratio? All right, so one of the big factors, I said 45 is kind of the goal to shoot for, but one of my favorite programs that's available to anybody, not just first-time homebuyers, FHA, you can have a DTI of, it's actually less than 57, but you can go all the way up to 56.99%. Pretty cool. So this is a very flexible program. A lot of people end up going with this in Southern California just because it's so much easier to buy a house if you have this 57 number working for you as opposed to a 45%. Okay. Reminder how student loans work for DTIs. This category. Student loans. So there's lots of funny things that have happened with student loans in the past. Vince, I'm gonna answer yours real quick because it's a quick one. FHA only requires 3.5% down. And there are programs that layer with an FHA to do less than 3.5% down. So we'll write that down. All right, so student loans. Lots of things have happened to it. Lots of people are in deferment on student loans. So there's lots of different ways that they've changed the guidelines a lot on them. The most common way that it's done is if your student loans are in deferment, then we're going to use 0.5% of what your student loans are towards the calculation. So if your student loans are at $100,000, but they're deferred for whatever reason, there's lots of reasons that people get deferred. You're only going to get charged, what is that, $500 a month? That's the payment that we'll use for student loans. There's different ways, like on a VA loan, they just change this. They'll do 5% divided by 12, so it's just kind of goofy. And there's some places that use 1% of the total balance, but it's really not so bad. And for student loans, there's lots of different ways you can repay them. It's not just like, hey, I signed up for student loans, here's my payment now. There's usually at least 3 different ways when you log into Nelnet. You can go in there and figure out how much you're actually paying. Because if you had $100,000 loans and we run your credit and it shows a payment of $60, that's what we're going to use. We don't care what anything else says. But if it says 0, then we use that 0.5% calculation. So if you go do an income-driven repayment plan on your student loans and you get a payment of $50, that's the number that we're going to use to calculate you for your mortgage. Now, it might not be the best idea to do that because if you're only paying $60 on $100,000, you're probably not paying the interest on your student loans, so they're going up over time, right? So if you on those income-driven repayment plans, if you only have, if you're not paying the amount that's going to cover the interest per month, your balance is going to go up over time. So we don't really like that because you're kind of compounding debt upon yourself. So you don't want to do that if you can. But that's why they have the income-driven repayment plan, because some people can't afford the payment that would cover the interest. So that's what they do for it. All right, so we got FHA loans. This is the back-end DTI ratio. Only 3.5% down, can be layered with a DPA. And then, all right, so we got some new people in here, so we're going to talk about the how to pay off your mortgage again. I will fix the glare next time, I promise. These red lines are notes from me, so I know where the glare is. So I like the little layout that I had before. So we're going to stick with that. So one thing that's important is this amortization curve. So this one up here is an amortization. So this means how much are you paying on interest or principal on your loan from start. And so this is year 1. That's not the one with the dot. And this is year 30. So on the first payment you make, it's mostly interest. On the last payment you make, it's mostly principal. So say your payment's $1,000, 970 of that is going towards interest, 30 of it is going towards principal on your first payment, and about 15 years is when it flips. So you're paying about 50-50 in the 15th year, and your last one is going to be about $970 worth of interest, or sorry, $970 worth of principal and $30 worth of interest, but your payment's going to stay consistent throughout the whole time. So you're still going to only pay $1,000 a month. It's just how much it's allocated to is going to switch over time. And so, all right, so we did the example of $3,000, so we'll do that again. So say your payment is $3,000, and that's how much you've mentally budgeted for in your checking account. Checking. And so what a lot of people do is they will take that money and they'll send it directly to their mortgage. And if this is what you do, you're going to pay it off in 30 years. So you will not pay off your loan early. It'd be 30 years it'd take you to do that. So one thing that other people like to do is instead of doing that, they'll take $3,100 and they'll send that to the mortgage company. So this will pay it off faster, but you lose access to that $100. It goes into an account that you don't get to see. It goes into your house, which turns into equity, which is difficult to get out. So let's say in this scenario, you'd pay it off in 27 years. I have calculators that'll tell you exactly how long and how many payments it would take, but I just don't want to go through that right now. So we could do that and pay it off in 27 years. But what I'm proposing is that we take our $3,100 and we send it to a savings or a money market account. And in here, we're going to earn roughly about 4% per, it's not per month, per year. So that the monthly rate is 4% divided by 12, which we said was 0.003%. So it's pretty small. But this is going to end up being about, if you left it in here for the entire month, you earn about $10. So you'd make $10 just by doing this. And a lot of people don't know is that your mortgage is technically, they give you the payment and you can pay it on the first. So if we pay on the first, we'll say it's quote unquote due. But if we wait until the 15th, that's the first time that it will be issued a late fee. And then you actually won't be issued late on your credit unless you wait until the 30th. So you'll get a late fee if you pay after the 15th. You get a late reported to you if you pay after the 30th. So the goal is to make your payment before the 15th without incurring a fee. So we're going to leave this money in this account right here. This savings account is going to earn us $10 a month if we put it in there. And if we only leave it in there for half the month, we're going to earn about $5. So let's do this one last step, is that we send this $3,100, or we only send $3,000. Oh boy. $3,000 into the mortgage. So instead of paying an extra $100 to the mortgage where we can't get access to it, we put it in a savings account. It's going to compound at 4% interest per year. And then we put it into, we only pay $3,000 in mortgage, but we're going to pay it off. It's like 27 and a half years. So we lost a year and a half. But now we've got this that's growing over time. So now we've got $105 in here. And that's going to go up and up and compound on itself. And if you've read the law of compounding, should be good to go. Hang on, I got a couple seconds. All right. And so we're going to gain $5 this month. The next month, we're going to gain $5.10, and then it's going to go up and up over time. So the next month, we're going to do the same thing. We're going to take $3,100, send it to the savings account. That's now going to have $3,205. And then we're going to send $3,000 to those suckers at the mortgage company. And then at the end, we're going to end up with about $210 in here. So you can see this is going up over time, and we'll get to pay off our mortgage. There was something I was going to say. Oh, one key thing with this is that if you're setting this up manually every single month, you will not do it. You'll do it once, twice, maybe 6 times, but you will eventually stop. So the key to this is to set it and forget it. You can make all of these automated transactions recur every single month. So you can have your checking account. So just like how you set up auto pay on your mortgage. So instead of saying $3,000 directly to the mortgage company and you pay it off in 30 years, send $3,100 to a savings account on the first every month. You can also do it every time that you get paid if you want to earn a little bit more. So if you're paid semi-monthly or bi-weekly, send $15.50 every 2 weeks to your savings account. And so get a couple of extra days of compounding interest. And then the same thing in your savings account on the 13th or 14th. Make sure it's got a day or two in case there's a weekend. You can do it on the 12th if you're a little risk averse, to make sure that it goes to the mortgage company on time so you don't get this 15th late fee. All right, are there any questions on this? Just and as a reminder, this is not as fast as paying your mortgage off directly, but it gives you liquidity. And the whole goal with paying off your mortgage is not to get your mortgage balance to zero, is to provide you financial freedom. So you got to ask yourself, why do I want to pay off my mortgage? A lot of people, when you say that, well, I don't want to be chained to a payment. Okay, well, if I made it so the payment didn't mean anything to you, it didn't bother you at all, would that be the same effect as not having a mortgage payment? Then yes. And so if we did this and ended up with $100,000 in the bank and $100,000 mortgage, you'd have the mental freedom of, I can pay off my mortgage whenever I want. I don't even need to make that payment. I can. I don't have to. That's the financial freedom that we're looking for. And also, with having the $100,000 in the bank, you can spend it on a variety of things. You don't have to spend it on just your mortgage. Say you had a life emergency, somebody got medically ill, and you got to pay for a $20,000 surgery. You can now do that without leveraging your house. It's already leveraged. We got the money. Just move it. We can get you the money in a couple days. Not let me go apply for a loan and see if I qualify for it and if I've got equity in my house or not. And you go on there and you can just get the money out from a savings account. So it's very easy. So let's talk about the difference between this key factor right here, savings accounts. There's two different ways we can do that. One is a savings account, one is a money market account. There's a couple of differences. I'm not a financial advisor, so I don't know exactly what these differences are, but I'm going to give you my what I believe I know. I'm open to learning from anybody if you know more than me or know something different than I do. So I like the red and blue. I think that really popped. We're going to do savings account here. And then money market. So a money market is kind of like a savings account, but it's usually managed by a professional. So you can do something in here. And if it is managed by a professional, sometimes they'll charge a fee. So you want to kind of be aware of that. And if you're only using it for this mortgage payoff thing, then it's probably not the best idea to have this managed by a professional unless they're going to give you the money market account for free so they can do other things with your money if you invest with them in an IRA or a different account. So money market accounts can have a fee. Fee sometimes. So that's a down vote. But they have higher interest rates. And we're going to call these APY, annual percentage yield. So it's not going to be a huge difference. So say we're looking at a 3.8 here, you're going to get 3.9, maybe 4.2. It's not going to be a life-changing number, but it is higher. So, and again, the compounding effect works better. So if you do a 3.8 to a 4.2, you're going to compound faster. It's going to work better, but it's not going to be a huge difference. The other bad thing about money market accounts is they're typically not FDIC insured. So that means that if that bank that you're got your money market account with ever goes belly up, you probably are not going to get this money back. But the risk of this bank going belly up is very, very low, especially because the last time we had a banking crash, everybody got bailed out anyway, so not a big deal. But that's the risk. So you get higher yield. Sometimes there's a fee if you have it managed, and they're not FDIC insured, which is a pretty low risk because chances of any bank going completely under without you knowing about it are pretty low. So savings accounts, we're going to do an upvote. No fee. At least there shouldn't be. If you're at a bank that does have a fee for savings accounts, just switch banks. Forget it. There's plenty of places out there that don't have fees. So we're going to do a downvote as the opposite of this. Lower APY. They tend to not have quite as high. Again, not a detrimental cause, but it's going to be different. And then an upvote. They are FDIC insured. So if this bank ever goes belly up, you would get your money back. They are insured. Are there any questions on these two? Any other ideas on these two? All right, cool. If anybody does want to see how much they qualify for, or if you have a mortgage question in general, you can give me these different qualification factors. Income, assets, credit score, and monthly debt. I can tell you how much you qualify for. Or if you just have a question, I had somebody on here asking how they could buy a bee farm. Figured it out. We got it done. So we're gonna move on with our lives. Okay, so one of the ways we can draw this is, I like this graph, is we're going to have this be, uh, this is years, so 1 through 30, and this is your payment, let's say P. This is the graph I was looking at. So we're going to do principal. Just going to go this way. And interest going to go this way. So that is really what it looks like in a more colorful version. So as you can see from year one, we're paying, this is your total payment. No, that looks like a D, it's a P. This is your total mortgage payment. Year one, paying very little principal, lots of interest. You switch it over in about year 15. This isn't a great drawing because I'm not an artist, but this is about year 15 where everything starts and it's equal. So if you did a 15-year loan, yes, you're going to be paying less percentage of interest of your monthly payment, but that's not the really the key factor. And then the interest starts up high, ends up your last payment's very little portion of your payment. Your principal starts very low, then your last payment is very high on the principal. All right, well, it's 5:30 where I am. I'm ready to get out of here. If I don't get any questions in the chat, this is my handle on pretty much everything. Instagram, TikTok, YouTube. If you want to find me, go there. If you want to email me, you got a personal question, it would be, you can message me, or some people like email. It's Rob at, that's supposed to be an A, robyourlender.com. I'm a mortgage broker, been in the industry for 10 years, loving it, love helping people get houses and achieve the American dream. If you do have questions, please reach out to me, and I'll see you.